Hey traders, good morning. Today is Saturday, November the 26th, and wanted to chat about an interesting aspect of our trading approach, which is the idea of adjusting trades rather than taking stop losses. I don't know if it's our claim to fame or how you really want to put it, but probably the majority of the members that we have in our trading room, one of the things that attracted them to us was our approach to trading, this dynamic rather than static trading approach, where rather than putting a binary trade together, a trade that is either going to work or doesn't, and you use a stop loss in case it doesn't, we, instead of that, will use a dynamic approach to trading, and we will adjust the trade as time goes by to bring the trade back into line with where we want to be. And one of the questions that came up in our trading room from one of our newer members recently was, okay, we've got a lot of training videos on the type of adjustments that we do and how those adjustments can affect a trade. Some are very defensive in nature, some are offensive in nature. But the topic of really when do you adjust and when do you cut the cord? When do you just throw in the towel and take a loss? How is that decision made? And so that's what I wanted to talk about in this video today. The question of when do you adjust, or when do you decide to just throw in the towel and take the L, take the loss, okay? So one of the important things I think about the way that we trade is some of the mantras that we try to follow in our trading. And one of those mantras is that we hope for the best and we expect the worst. We always expect the worst in our trades. So our attitude towards all of our trades is that every single trade we put together is not only going to be a losing trade, but it's going to be a max loss trade. And I always use the example of my son in this example. I have an 18-year-old son now. He's just off to college now, so he's not doing a lot of trading anymore. But when he was 16 and 17, he'd built up quite a sizable account for a teenager. He had about $9,000. And he loved to trade the 1 and the 2 date expiration NDX credit spreads. And so, we would put a trade together for, say, $5,000 that would bring in a $400 potential income. Now, for him, that was amazing. That was the world. That was so much money. And that's, of course, all he can see is that $400 that's going to come in. But, of course, our attitude is, well, we expect the worst. I said, yeah, no, the 400 would be great, but what would be the worst case scenario here? And of course, his answer was the answer that a lot of traders have, which is, man, if I'm honest, I don't really know. I don't really know what the max risk in this trade is. And I would say, well, of the $5,000 you have at risk, you could potentially lose, let's say, $4,100. Of that $5,000 if the trade went max loss against you. And of course, he would freak out and say, well, that's horrible. I can't do that. That's too much risk. Okay, then what would we do? And when would we do it? When would you start making changes to this trade? When would you start adjusting it? And how would you do that? And how much risk would be acceptable in this trade? One of the other mantras that we try to follow in our trading is that there are a lot of variables in whether or not our trades make money or not. Most of those variables are out of our control, but one variable that is always in our control is risk. You and I, as investors, control the risk of a trade. There are no risky trades. There are no risky markets. You and I, as traders, are the ones that decide what the risk of a trade is, because we control that from our aspect, from our side of putting the trade together. So number one, our attitude towards all of our trades is that we hope for the best. We hope they all work out, but we expect them not to. We're never ever shocked. We're never ever surprised when a trade goes against us, because we kind of planned on it from the outset. And so with that, we then understand, okay, well, we need to do some things differently than maybe other traders. If I'm going to commit $10,000 to this trade, whereas a normal trader might put all $10,000 into the trade and then make it a binary trade, meaning it's going to make money or not, you use a stop loss to manage that risk, and it either works or it doesn't, we might start with 1,000 of the 10,000, keeping a lot of dry powder on the sidelines so that we can adjust and manipulate and enhance and change that trade as time goes by. So number one, our attitude towards all of our trades is that they're going to lose money and that we're going to need to step in at some point and fix them, adjust them. Okay. Now, this idea, this power of adjusting versus a stop loss, it's a siren song. It's very intriguing to traders. This idea that you can take a trade that is losing money and actually fix it to where it's making money. It is a very, very alluring idea. And again, it's one of the primary reasons that I think a lot of our members come to our trading program, is because we do focus on adjusting rather than taking just a standard stop loss. And of course, all a stop loss does is guarantee you a loss. It might be a small loss, but it's still going to guarantee you a loss, right? But the problem is, once you learn how to adjust a trade, you start adjusting everything. You start adjusting any and every trade out there, because you're just like, well, I'm never ever going to take a loss ever again. I'm going to adjust every single trade that ever goes against me. And that doesn't always work. That doesn't always make sense. Sometimes you're throwing good money after bad. And sometimes there is a point where we say, look, this trade is not the trade that it was when we initiated it. And it doesn't make sense any longer to continue to stay in this trade. We need to do something different. We need to cut the cord. We need to take the loss. We need to move on. So there is some tremendous power in being able to adjust a trade. I look at our 0 day to expiration, our 0 DTE trades, which I think, as far as I can tell on the internet, from what I've been able to see from people that are willing to actually publish publicly their results, we have the #1 track record of any 0 DTE program on the internet today. There may be some that are better that just simply won't publish their data, but that's a little circumspect, I believe, if they're not willing to publish their data. But this year, so far, we've taken about 190, somewhere in that range, 190 0 DTE trades, and 181 of the 190 have worked. They've made money. So 9 have lost money, 181 have made money. Now that's and the ones that have lost money, the average loss on them has been about 2.8 times the credit received. So fairly well managed losses. Amazing track record, but better than a 97% success rate on those. That's wonderful. That's great. But the reality is that of those winning trades, probably 70 to 80 of them, probably 70 to 80 of those trades, at least, I'm going to say almost at least half of the 0 DTEs that we have done so successfully this year have needed work. They have needed adjusting. They would not have ended up making money had we just let them sit statically on their own, go to expiration, and use the buy and hope approach that, oh, I hope it works, and if it doesn't, well, I've got a stop loss to back me up. So again, there is some tremendous power in adjusting a trade, but we also have to understand that there is power in knowing when to walk away from a trade as well, and potentially take a stop loss, take an exit, move on. So how do we do that? Well, there's 2 requirements that we use to decide when to call it quits, when to continue adjusting a trade, and when to call it quits. And the first one that we use is a wonderful, wonderful thought process that was developed by a wonderful man. His name is Brian Tracy, and it's called zero-based thinking. And then the other aspect that we bring into play here, the other requirement that we have is, does it allow for what we refer to as a trifecta type adjustment? Trifecta meaning 3. And so there's 3 primary criteria that we look for in that adjustment. Not all of our adjustments meet that criteria. We can't get a trifecta on every single adjustment that we do, but that's what we're looking for. Okay, so let's get into this. Let's talk about what zero-based thinking means, what that implies for us as traders, and how we can use it in deciding whether or not we should continue down this road of trying to work this trade into the profit zone, or just cut the cord, take the loss, and move on. And then we'll get into what the trifecta adjustment is and why we think it's so critical in terms of being a requirement for, hey, do I continue to work this trade do I continue to put my money at risk in this trade, or do I pull the risk, get out of the trade, and move on? So zero-based thinking, again, it was a strategy or an idea, a thought process that was put together by the great Brian Tracy. And of course, today, Tony Robbins is the noted master genius of personal improvement and controlling your thoughts and focusing on being the best you can be. But Brian Tracy really was the grandfather of all of this personal development space. In fact, a lot of what Tony Robbins does, I don't want to say he stole it from Brian Tracy, but he tutored and mentored with Brian Tracy. And Brian Tracy is just an amazing person. He has so much insight into everything. And I think his zero-based thinking approach is just masterful, not in only in terms of trading and understanding what you should be doing or not doing with a trade that is currently not working out for you, but just life in general. And so the idea here with zero-based thinking, Brian says, when you begin to plan your long-term future, one of the most valuable exercises you can engage in is zero-based thinking. In zero-based thinking, you ask yourself this question: knowing what I know now, is there anything that I am doing today that I wouldn't start again if I had to do it over? So we get into ruts, we get into trades, we get into relationships, we get into careers, and we get down the road a little ways and we're like, wow, knowing what I know now, I probably wouldn't have reinitiated this process had I known at that point what I do know now, right? So it's just sort of thinking that way. And it says, no matter who you are or what you're doing, there are activities and relationships in your life that, knowing what you know now, you wouldn't get involved in, right? So zero-based thinking became a big part of marriage counseling when this originally came out. The husband and wife been married for 30 years and they're not getting along, and they go to the marriage counselor, and the marriage counselor says, well, you guys know each other pretty well, right? And they say, oh, yeah, we know each other really well. 30 years of living every single day together, and it's not working out. And he said, well, let me ask you a question. Let's figure out if this is savable or not, right? Knowing what you know now about this person that you're with, you spent 30 years together, you know them in and out. Knowing what you know now about this person, if you were to meet them for the very first time today, having all of this knowledge, would you ask them out again? And a lot of times the answer is, well, heck no, absolutely not, And so that's kind of the idea behind zero-based thinking, is that we get into things with the best of intentions. We get into trades with the best of intentions, but then things evolve and things change. And the technical patterns, the market dynamics, the corporate situation with that company, they alter, they change, they adjust. And you have to be able to say, okay, where I'm at today in the trade is different than where I was at when I initiated this trade. Knowing what I know now, should I keep trying to pursue this trade into the profit zone, or should I just cut the cord? Okay, so that's the first step that we look at. I think a lot of times once we learn the power of adjusting trades, it just becomes a perfunctory, hey, I'm never going to take a loss ever again. I'm going to adjust this thing until the sun goes down and the cows come home. And I'm going to work this trade for 6 years if I need to, and I'm just never, ever going to take a loss. That's not the right way to trade. So zero-based thinking, we have to look at the trade with fresh eyes. You bought a stock at 20, thinking it's going to go to 30. And for whatever reason, everything falls apart. The trade is now gone from 20 down to 15, right? Do you stick with that stock? Do you stick with that trade just buying and hoping that it's going to work out? Or do you use zero-based thinking and say, no, you know what? The dynamics of this trade have changed. Knowing what I know now, I would not step back in and buy that stock at 15. Okay, if that's the case, then you need to cut the cord and move on. However, a lot of times you'll say, no, I thought this was a great buy at 20, thought it was going to go to 30. If I thought it was a great buy at 20, I think it's an amazing buy at 15. And in fact, not only do I still like this trade, I like it even better. and I'm going to commit even more money to the trade. Okay, that's zero-based thinking, trying to figure out based on the new information that we have if it's a trade that still is viable or not, because trades change. The trade we put on yesterday is rarely the trade we have today. Okay, so zero-based thinking. Trifecta. What is a trifecta adjustment? Well, trifecta implying three different aspects. The number one part of a trifecta adjustment that we look to achieve, and maybe one of the easiest parts of an adjustment, is gaining more time in the trade. Sometimes we'll put a trade on. Most of our trades are level to level. So we're finding support resistance areas that we feel that an underlying is going to stay within. And maybe we're wrong. Maybe it breaks through one of those levels. And we still feel good about those levels. Maybe we just have run out of time. Maybe it's a zero DTE. Maybe it's a day trade. Maybe it's a short-term trade. And we say, you know what? We still really like this trade, but we have run out of time. The options are expiring. We need to gain more time. So rolling the trade out for more time, whether that's a day, a week, a month, or what have you, but being able to roll the trade out, that's one aspect of being able to adjust a trade, gaining more time to let our thesis work its way out and prove that we were right. Sometimes that's all a trade needs. A trade that's not working, sometimes that's all it needs is just a little bit more time for us to be proven correct. So number one, we want to make sure that the adjustment has the ability to roll out in time. Number two, ideally, we would like to make the trade safer. We would like to have the probability of success greater. We would like to be able to roll our strike prices out further, right? Let's say that we sold a naked call, or we sold a credit call spread on something at $20 a share because it was at 15 and we didn't think it was going to get above 20. But now it's pushing up around 18, 19. It's pushing up around our short strike of 20, okay? We need to make that trade safer. We don't just need to get more time in the trade, but we need to make it safer, because when we put the trade on, it was at 15. Now it's at 18 or 19. So we need to be able to roll those strike prices out further away from where the stock is. Maybe instead of selling a short leg at 20, we can sell it at 22.50 or maybe even 25 or 27.50. But we can give that trade a little bit more room to breathe, a little bit more room to work so that it's not so tight. So number two, we want to make the probability of success greater. The trade needs to look improved. If the trade is actually increasing risk rather than decreasing risk, that might be where we need to go back to zero-based thinking and say, hey, are we really doing the right thing here? Okay. So number two, we're going to try to create a greater probability. The POP on the trade should be better. There should be a bigger area that the trade can move within, and we still end up making money. Last but not least, number three, the adjustment needs to make the profit potential of the trade accretive. And what we mean by accretive is it needs to bring in extra income. So I get this all the time where somebody will say, you know, I put XYZ trade on this stock. It went against me. I started to lose money, but I didn't want to throw in the towel. So I've adjusted and adjusted and adjusted and adjusted. And here we are now 6 months later down the road, and I've been able to exit at a profit. And they want accolades for that. But I look at the trade and I say, but the trade wasn't accretive for you. In other words, your rolls, your adjustments over the past 6 months have not been bringing in extra income. And so while the rate of return on your trade was pretty impressive for the 2 or 3 week period that we initially put it on, it's not impressive at all now for a 6 month period of time. You probably would have been better off taking the loss right up front in the first couple of weeks, getting your capital back and trading more successful strategies over the subsequent 6 months, right? So the adjustment needs to bring in additional profit. Every time we roll, that means we want to roll at a credit. That means we want to be bringing more income potential into the trade. Our profit potential on every roll that we do should be increasing, not decreasing. Now, again, it's not always possible in a roll. There are situations where we do zero-based thinking. It makes sense to do the adjustment on the trade, but we get to the trifecta part and we can't get all three of these done. Maybe we only get 2 out of the 3. So again, it doesn't always work that we can get a trifecta adjustment, but that's our goal, is that every time we roll, we should actually be enhancing the profit potential of the trade. That's the idea behind all of that. So hopefully that helps you guys understand a little bit about when we adjust versus when we just call it quits. It is this attitude of, hey, all our trades are going to fail on us. We know that up front. We expect it up front. We're going to scale our capital in slowly so that we can adjust versus take a static stop loss on these trades. And we're going to use zero-based thinking and the trifecta adjustment approach to try to manage these. So hopefully that answers the question on when, not how. We've got a lot of training videos on how do we adjust, but when do we adjust versus when do we call it quits. So let me know in the comments if you have any questions on that. If you are interested in participating in our live trading room, you can do so for free for 7 days. You can come hang out with us, trade alongside with us, see one of the most comprehensive live trading rooms on the internet today. You can just go to the website try0dteforfree.com. Come spend some time with us, chat with our members, see what they think, ask your questions, and I think you will come away with some greater understandings of maybe there are different ways to trade. So hopefully that was a help for you guys. Take care. We'll talk to you soon.